Okay, looks like we are live. Welcome for another properties and beers. If you're watching this, come say hi, drop me a line in the comments, and let's chat, right? There's a few things that we want to have a chat about, right? So let's chat about what most investors are accepting. They're accepting 3 to 4% rental yields. At the same time, there are markets delivering up to 10, 12%. Very different outcomes, right? We're talking about 3 to 4x the results. And that's how the constant media discussion around housing affordability, tax changes, investor behavior. We're going to be chatting about all of that because it's easy to get distracted. And tonight, my friends, I'm going to help you simplify the hell out of it. Where's the cash flow today? What actually drives performance? And you know what? How does policy shape the market? We're going to be chatting about government policy. I know, controversial, right? Let's get started. What do we have today? We have an actual alcoholic beverage. I know it's been a minute, right? We have a Sachi 8. I don't know if you guys can see that, but that is right. That's a look, it's a Korean crisp yuzu 8% beverage. That's right, 8% in a yuzu beverage. Let's give it a go. Oh, it's nice. It's kind of has a bitter undertone, which you want with something lemony. I'd like a little bit more lime in it. It is like kind of sweet. I wonder how much like sugar they've actually got in there. They don't have the ingredients listed, but you know what I'm going to do? I'm going to get some ice in a glass and chuck it in, and continue having sips along with you, my friends. So, for those that don't know me, I'm Gaurav Gupta, CEO and founder of Ethical Property Investments. I work with everyday Aussies just like yourself to invest in high cash flow property that's built to do good and make money. We're talking real property, real numbers, and hell, real sustainability. So, tonight we're going to cover three things. First, and the very first thing is the reality of SDA, straight from one of my own properties. Second, where stronger cash flows, exist in today's market. And third, the capital gains tax conversation and how that policy influences behavior, right? So before we get started, I need a sip. It's been a while since I've been in the office doing this with you, so it's a pleasure. If you're here, drop me a line. I'm watching on the other screen to see if there's any comments. Actually, I'll make the screen a little bit smaller so I can see whether you guys are watching and dropping comments. There you go. Yesterday we ran the NDI Specialist Disability Accommodation Reality Check webinar. I walked investors through one of my very own personal SDA properties, or one that one of my trusts owns, right? And when you stand inside the asset you own, my friends, those conversations, they change. You actually start focusing on different things, and things that are like suburb selection, category positioning, operational structure, compliance precision, and we're still going through some compliance stuff today, right? Demand sustainability, because my friends, specialist disability accommodation rewards details. It rewards the investors who truly understand the mechanics and the people living in the house. So, you know what? High level conversations create average outcomes. Specificity creates performance. In the webinar, we covered vacancy data, category level differences, funding mechanics, operational considers, because you know what? SDA isn't about the headline return. We actually covered it warts and all. It's about sustainable return. So if you want the replay, comment below, and one of the team members will send it through to you if you want the SDA replay for the webinar we did. And you know what? I covered some of our very own personal challenges investing in SDA, because I'd rather be real, right? And one of these things that I see in all these like salesy webinars, they tell you all the great stuff, put you through some pleasure and pain, and do some funky sales shit, part of my French. But I can't help but being real on the webinar. So if you want a copy on the NDI Specialist Disability Accommodation webinar, run out of a real SDA house that's about to become operational, drop me a line in the comments, and then my team will get it through to you. Let's chat about the second topic, and I need a sip. This is super duper sweet. I like it, but I don't know if I'd get it again, by the way. Those that are just watching, having the Sachi 8% business. A little bit too sweet. I don't want my drinks way too sweet. I prefer not to drink the calories, so to speak. Topic 2, cash flow. And that's a separation point for some people. So let's zoom out into like a broader market. The national average rental yield sits at around 3.5%. Now, that doesn't create much margin for people when they're paying their interest rates at 7%, or even 6%, and they're at, even though 80% leverage. If you know your maths, and I'll do some quick maths, basically you're paying around 5 or 6% overall, and your rental yield is 3.5%, and people still think that investors are investors are from hell, right? But you know what? These are mums and dads, and they're teachers, nurses, etc. But there are some markets delivering yields north of 7 and 8%, and they're driven both by fundamentals and the type of build you do. But here's the thing, right? Cash flow determines flexibility, and flexibility determines long-term success. For example, one area I wouldn't be chasing is an area that's hyped, like Darwin. In select pockets, yields are above 6%. It's really horrible, right? I wouldn't be investing there. But what I like to do in areas where growth typically occurs, I like to create cash flow options. Some of those cash flow options, for example, are co-living and rooming housing. And here's the thing. Have you ever looked at a property and thought, it looks impressive, but will the numbers support it? That instinct is healthy. Investing is totally about structure. And it's really important that we look at what the cash flow actually is on a property, because less and less people can afford things. I'm finding more people coming to me with like borrowing capacity of 600,000-700,000, and we just can't help them, right? At the moment, median house price in most cities is sitting at close to that $1 million mark. And if your borrowing capacity isn't there, you need to start looking at higher cash flow options. Unfortunately, if you're looking at yields above that 3 to 4%, most markets just can't sustain it. You have to manufacture cash flow. And though there's a couple of ways to do it. For example, in New South Wales, a lot of people do it by putting in granny flats. In Victoria, we're able to do co-living or specialist disability accommodation, very similar to Queensland. Queensland's got a strong rooming housing market as well. A lot of strong Airbnb markets, but be careful with Airbnb. That's fraught with potential challenges. Ask me again on the next properties and beers. So, the third topic, and that is taxes. I know. I had to look down while I was talking about it. No one likes taxes. Let's talk about policy, because policy influences behavior, and behavior influences supply and demand. There's discussion right now about potential capital gains and tax adjustments. Nothing is confirmed, but it's understand how tax influence market activity. Now, markets respond to incentives consistently. Back in 1985, when these grandfathering rules were introduced, many investors held assets for longer. And internationally, similar behaviors appeared in Sweden and Canada. When holding becomes more attractive, supply can tighten, and supply tightens, pricing dynamics adjust. There's also a timing effect, right? When policy adjustments are anticipated, activity often accelerates beforehand, and after that clarity returns, the market stabilizes. And that highlights one core idea, that fundamentals still matter most. So, my friends, let's talk about capital gains tax a little bit more. I've got some major challenges in what the government's trying to do. Call me cynical, but if you take away incentive from investors to build houses and demonize them effectively, which is what governments are doing, you're going to have less houses, because, hey, who else is going to build them? The government's not building that many houses as we need. They haven't. It's not just about the last couple of years where we've had increased activity. Hell, we had a housing crisis during freaking COVID when there was no people coming into the country. So yes, while immigrants are a little bit of the challenge, they are not the be all and end all. We had a housing crisis then. We had a housing crisis prior to then. 3 to 4% vacancy is already a short market. And if you're saying, I'm going to get rid of capital gains tax, I'm going to demonize investors, I'm going to do this, guess what that's going to do to the average person? They're not going to give a shit, pardon my French, about investing in property. They're just going to put their money in the stock market. Hey, you know what happened in an area where my family in a different country found it too difficult to invest in property? They took that money that they made from property and they invested in the stock market, where they were getting, get this, 18% return. And what you don't want to do is demonize investors so much that there's no property stock out there thinking that people will buy property owner occupiers while the interest rates are going up. So call me crazy once again. But this whole demonization of investors and getting rid of these tax incentives are actually going to have the opposite of the intended effect. If the intended effect is to ease the housing market, we should be incentivizing investors. I mean, we are one of the few countries in the world that has got a capital gains tax. And there's also tax about taxing unrealized gains. Don't get me started. I've got a whole thing about how the government chooses to tax, and I will go on about that on a Facebook Live for hours and hours and hours. My friends, I would encourage you to look at what the government's trying to do from a taxation point of view, because there will come a point in time when the taxes are so high, just like there's a particular thing happening right now. It's called the tobacco situation, right? Where they've taxed it so much that people just have an alternative to buy. And what you don't want to have happen is the same thing where it becomes so hard for people to live in the country, to invest in the country, that they take their money elsewhere. I mean, Aussies are already investing overseas, and they're going to continue doing more and more. People are going to go move to Dubai, Bali, etc., etc. Not just because they were like, they wanted to do it, but almost because their hand was forced by the government and their absolutely crappy policies in terms of overtaxing the people that have worked hard their whole lives, instead of taxing the organizations that should be taxed, like mining companies, right? We could be like Qatar and taxing the mining companies instead of taxing the average investor. And yes, I love Punter's politics. Those that don't follow him, check him out. He's got some really good talking points. Well, I don't agree with 100%, just like I don't agree with everyone 100%. 95% of his stuff is really good, and we should be taxing large companies more, not the average person, not the average, I guess, middle income person like you and I watching this. So I'll bring it back, right? As an investor, I believe the focus should remain as cash flow, demand, location selection, supply awareness, and resilience. And in closing, let me leave you with this. Media cycles move quickly. Policy discussions get to evolve. Markets adjust. But investors who perform consistently stay focused on fundamentals, right? I repeat again, fundamentals, right? They understand the mechanics. They run the numbers. They make the right decisions, and they structured decisions, if you will, right? Now, if you found this useful, follow Ethical Property Investments regular breakdowns. I promise I'm never going to drink this again. Follow us for weekly properties and beers, or not beers, depending on what I'm drinking that week. Stay informed, stay structured, stay long-term. And my friends, I'll see you at the next session. Cheers. Have a fantastic weekend. Cheers, guys.